Everyone is watching inflation, recession risks, and the Fed, but the biggest threat to the market is something almost nobody is talking about. A silent killer that just crossed $38 trillion, the fastest debt accumulation in U.S. history. In just the past 12 months, the U.S. added over $2.5 trillion in new debt. That's nearly $200 billion every month. And markets are starting to panic. Rising debt drives bond yields higher. Higher yields crush stock valuations. And in every past spike, from 2011 to 2018, the S&P 500 dropped between 5% and 17% in weeks. The question now is simple. Is this another temporary shock, or the beginning of a much bigger problem? The U.S. national debt is quietly but steadily swelling, becoming a silent killer of financial markets. It has now exceeded $38 trillion, which is a historic record. To put this into perspective, this is more than the combined annual output of the Chinese and Eurozone economies. In relation to the performance of the U.S. economy, the debt is approaching record levels seen after World War II. Worse still, the pace of debt accumulation is extremely rapid. In the last 12 months alone, the U.S. has had to borrow over $2.5 trillion. By comparison, around 2000, $1 trillion in debt was added roughly every 2 years. In 2010, it was every 11 months, and in 2020, it was every 5 months. Unsurprisingly, budget deficits remain well above the historical average and do not appear to be significantly decreasing in the foreseeable future. The budget deficit for fiscal year 2025 is estimated at around $1.8 trillion. But why should investors be concerned about record debt? It's simple. Growing debt is already affecting financial markets and the real economy. The government finances its debt by issuing government bonds, and as it sends more and more of them to the market, investors demand higher interest rates, or yields, as compensation for the greater risk and supply. The result is rising yields on U.S. bonds. At the beginning of this year, the yield on 10-year government bonds exceeded 4.5%, and 30-year bonds even exceeded 5%. Such an increase in interest rates makes borrowing more expensive across the economy. For example, mortgages, car loans, and, importantly for investors, corporate investment financing. The U.S. Government Accountability Office warns that high government debt means higher interest rates on household loans, lower corporate investment, and pressure for lower wages and more expensive goods and services as a result of potentially higher inflation, to which interest rates are linked. This whole mix, led by higher interest rates, is also reflected in stock valuations. When government bonds offer higher yields, as they do now, investors are less willing to pay high prices for riskier stocks. Expected stock market returns must compete with the attractive yields of safe bonds. Higher interest rates slow economic growth, reduce corporate profits, and investors are then unwilling to pay such high multiples of earnings for stocks as they would at lower rates. All of this leads to downward pressure on stock market valuations. It is therefore not surprising that sharp rises in bond yields have often resulted in stock market corrections. Historically, every rapid rise in yields has been followed by a significant decline in the S&P 500 index within a few weeks. For example, in 2011, during the debt ceiling crisis and the subsequent downgrade of the U.S. credit rating, the S&P 500 index fell by almost 17% in 11 trading days. Similarly, during the so-called taper tantrum in 2013, when investors were frightened by the Fed's sudden consideration of limiting bond purchases, stocks experienced a rapid correction. And in 2018, when the yield on 10-year bonds jumped above 3% per annum, U.S. stock indices lost around 10% of their value within a few weeks. Incidentally, McDonald's shares managed to grow in all of the above cases and deliver solid returns to investors. Investors on Bulios know this, thanks to detailed stock data, and are therefore prepared for any market movements. Growing debt is not the most talked about issue. We hear everywhere about bond yields, inflation, or declining investment, but it is debt that controls everything from the background. However, the impact does not end with the financial markets. Government debt itself is becoming a significant burden on the U.S. government budget. Rising interest rates mean that servicing the debt is becoming rapidly more expensive. Interest has become the fastest growing item in the federal budget. For context, over the past 10 years, the U.S. has paid roughly $4 trillion in interest, but over the next decade, that figure could reach an estimated $14 trillion. Such huge amounts that the state has to spend on interest are then logically missing elsewhere. Debt thus becomes a brake on long-term growth and a threat to the prosperity of future generations of Americans if its trajectory remains unchanged. And that poses a continuing threat to stocks. This video is over, but if you want to know more about individual stocks or markets as a whole, check out Bulios, where you'll find new analyses, articles, and top tools for stock valuation every day. If you register via the link in the description, you'll get a 10% discount on Bulios Black membership forever.